Chapter 10. Dividend and Interest. Question 2. Explain the following terms or concepts. 2 marks each. 1. Profit. Answer. Profit is the amount of money remaining after all the expenses of running the business are paid, that is, profit is equal to total revenue minus total cost. It is the positive difference between total revenue and total expenses for a given period. Profit is necessary for the survival and growth of business enterprise. If the business does not make enough profit, it will not survive in the growing competitive world. Profit means survival. The success of a business is judged by the extent of profit earned. Profit allows a business to fulfill the expectations of investors. Profit acts as an index of performance. 2. Dividend. Answer. The word dividend is derived from the Latin word dividendum, which means to be divided. Dividend is that portion of the profits of the company which is distributed to its shareholders. According to the Supreme Court of India, in case of going concern, dividend means portion of the profits of the company which is allotted to the holders of the shares in the company. Therefore, dividend is a share in the distributable profits of the company which is payable to the shareholders after declaration by the company. 3. Interest. Answer. Interest is the price paid for the use of others' money for a certain period of time. It is paid by the borrower to the lender. Therefore, it is the cost for the borrower and income for the lender. It is the price or consideration for the use of others' capital fund for a certain period of time. The company borrows money from debenture holders, bond holders, depositors, banks, financial institutions, etc., for business purpose, and pays interest to them, as per agreed terms. Company has to pay interest, even if it does not earn any profit. Therefore, interest is considered as a charge against the profit of the company. 4. Final dividend. Answer. The dividend declared at the annual general meeting of the company is called final dividend. The final dividend is declared after the close of the accounting year and ascertainment of net divisible profits of the company. The rate of final dividend is first recommended by the board of directors and then declared by the shareholders in their annual general meeting by passing ordinary resolution. Final dividend can be declared out of the profits of the current year and previous years, capital profits realized in cash, free reserves, and out of money provided by central or state government for payment of dividend. 5. Interim dividend. Answer. The dividend, which is declared by the board of directors between 2 annual general meetings of the company, is called interim dividend. It is paid before the finalization of annual accounts, that is, in the middle of the accounting year. Board of directors have to take opinion of the company's auditors before declaring interim dividend. Articles of association of the company must authorize the board of directors for declaration of interim dividend. Dividend includes interim dividend, and hence, entire provisions related to declaration of dividend shall be applicable to interim dividend also. 6. Unpaid dividend. Answer. The dividend, which is not paid to the shareholders by the company within the prescribed time of 30 days of its declaration, is called unpaid dividend. In such a case, the company is required to transfer the amount of unpaid dividend to a separate account, called unpaid dividend account. This transfer has to be done by the company within 7 days from the date of expiry of the 30 days period provided for payment of dividend. If the amount of unpaid dividend remains in the unpaid dividend account for 7 years from the date of transfer, such amount should be transferred by the company to the Investors' Education and Protection Fund, that is IEPF. 7. Unpaid dividend account. Answer. Every company has to open unpaid dividend account with a scheduled bank and transfer the total amount of unpaid or unclaimed dividend to this account. This transfer has to be done by the company within 7 days from the date of expiry of the 30 days period provided for payment of dividend. This means transfer should take place within 37 days from the date of declaration of dividend. If any amount of unpaid dividend remains in the unpaid dividend account for 7 years from the date of transfer, such amount should be transferred by the company to the Investors' Education and Protection Fund, that is IEPF. 8. Dividend mandate. Answer. In case a shareholder wants to get dividend directly credited to his bank account, he is required to send a request to the company in the prescribed form called dividend mandate. It is an authority to the company to pay dividend directly to shareholders' bank account. It avoids risk of loss in transit and saves time and money of the shareholder and company. 9. IEPF. Answer. IEPF stands for Investors' Education and Protection Fund. IEPF has been set up by the central government in 2001 under the Companies Act to pool all the dividends of the company's matured deposits, share application money, debentures, interest, etc., that are unclaimed for 7 years. Any amount in the unpaid dividend account of the company which remains unclaimed and unpaid for a period of 7 years from the date of transfer of such amount to the unpaid dividend account should be transferred by the company to the Investors' Education and Protection Fund, that is IEPF. Thereafter, the claimant of money will have to follow the procedure and submit necessary documents to get claim from IEPF. 10. Rate of dividend. Answer. The part of the annual profit of a company distributed among its shareholders is called dividend. The dividend is always declared by the company on the face value of its share, irrespective of its market value. The rate of dividend is expressed as a percentage of the face value of a share. The board of directors of the company decide in its board meeting the rate of dividend and total amount of dividend to be paid. The shareholders approve the rate of dividend recommended by the board of directors in the annual general meeting by passing an ordinary resolution. Shareholders shall not declare dividend exceeding the rate recommended by the board. However, they may reduce the rate of dividend as recommended by the board.